You wake up, check your mortgage rate, still high. You open your brokerage app, stocks are flat. Then you see the headline, the Federal Reserve pauses rate cuts, again. 10 votes to 2. Rates held steady after January's pause, and officials signal no rush to cut. So here's the real question. Is this the end of easy money expectations? And what does this mean for your portfolio in 2026? Let's slow this down and unpack it properly. At its core, the Federal Reserve controls the cost of borrowing in the U.S. economy. When inflation rises too fast, the Fed raises interest rates. When the economy slows sharply, the Fed cuts them. That's the balancing act. Right now, inflation is not falling fast enough. Core CPI recently printed at 3.60%. The PCE inflation trend, which is the Fed's preferred measure, stands around 2.71%. The official target? 2%. We are close, but not close enough. That gap is why the Fed is cautious. They don't want to repeat the 1970s mistake of cutting too early and letting inflation rebound. Now, let's make this very simple. Imagine Sarah wants to buy a $400,000 home. If her mortgage rate is 3%, her monthly payment might be manageable. If that rate jumps to 6 or 7%, her payment rises dramatically. That difference affects her decision. Multiply Sarah by millions of households. Higher rates reduce borrowing. Reduced borrowing slows demand. Slower demand cools inflation. That's how monetary policy works. But here's the complication. Consumer spending remains resilient. The labor market is still strong. GDP projections for the next couple of years remain positive as per latest available economic forecasts. If the economy is holding up, the Fed has no urgency to cut. But what if inflation stops falling? What if wage growth accelerates? What if energy prices spike again? Then the Fed may not just pause, it could stay restrictive longer than markets expect. That's why bond yields reacted after the minutes were released. Treasury yields adjusted upward. The dollar strengthened, and rate-sensitive stocks moved sharply. Now let's talk about winners and losers. In a high-rate environment, banks often benefit. Why? Because of something called net interest margin. That's the difference between what banks earn on loans and what they pay on deposits. Take J.P. Morgan Chase as a case study. According to its 2023 annual report, J.P. Morgan generated approximately $158 billion in revenue. Net income was about $49.6 billion. Net interest income rose significantly during the higher rate cycle. When rates rise, banks can reprice loans faster than deposits. That widens margins. Now compare that to a growth-heavy company like Tesla. Tesla reported roughly $96.7 billion in revenue in 2023. Net income was around $15 billion. Tesla's valuation depends heavily on future growth expectations. When interest rates stay high, the value of those future earnings gets discounted more aggressively. In simple terms, future dollars become less valuable today. That pressures high growth stock valuations. So while banks benefit from higher spreads, growth stocks face valuation compression. This is why sector rotation becomes critical in this environment. Now let's understand the safeguards. The decision to hold rates comes from the Federal Open Market Committee. This committee analyzes CPI, PCE, employment data, wage growth, and GDP forecasts. It is data-driven, not political. When officials say policy remains restrictive, it means rates are intentionally set high enough to slow economic activity. The goal is stability. Price stability first, growth second. Now let's break down revenue models more clearly.
Banks generate income from three main streams. First, net interest income. This is usually the largest contributor. Second, non-interest income, including fees from asset management, credit cards, and advisory services. Third, trading and investment banking revenue. In high-rate periods, the first stream becomes dominant, but sustainability depends on credit quality. If unemployment rises, loan defaults increase, and that erodes profitability. Now let's widen the lens globally. A strong U.S. dollar impacts emerging markets. When U.S. yields rise, capital flows toward U.S. assets. That pressures currencies in Asia, Latin America, and parts of Europe. For global investors, U.S. monetary policy becomes a global liquidity driver. Higher U.S. rates mean tighter financial conditions worldwide. Now let's discuss key financial metrics you should monitor. Core CPI. If it remains stuck above 3%, rate cuts are unlikely. PCE inflation. If it trends consistently toward 2%, policy flexibility increases. Unemployment rate. A sharp rise could shift the Fed's stance quickly. Treasury yield curve.
If short-term yields remain higher than long-term yields, that signals caution about future growth. For equity investors, valuation metrics matter. Price-to-earnings ratios tend to compress when discount rates rise. For example, if a company trades at 30 times earnings in a low-rate environment, that multiple may fall to 20 times when rates stay elevated. Even if earnings remain stable, the stock price adjusts. That's the math of valuation. Now let's examine another real-world angle. Consider Apple. As per latest available 2023 data, Apple generated around $383 billion in revenue. Net income was approximately $97 billion. Apple holds substantial cash reserves, strong free cash flow, low leverage. Companies with strong balance sheets are more resilient in high-rate environments. Contrast that with highly leveraged firms whose debt refinancing costs increase sharply when rates stay elevated. Debt-heavy companies face margin pressure. Cash-rich firms gain flexibility. Now let's address smart money behavior. Institutional investors are increasing allocations to short-duration treasuries. Why? Because yields are finally attractive. Parking capital in 3-month or 6-month treasury bills provides relatively safe returns. Holding cash becomes a strategic choice, not a defensive panic. At the same time, many long-term investors are preparing to buy dips strategically, not blindly, but selectively. Quality companies, strong cash flows, reasonable valuations. Now let's talk risks ahead. Upcoming PCE releases are critical. If PCE surprises on the upside, markets may reprice expectations again. Bond yields could spike, equities could pull back. On the other hand, if inflation data softens meaningfully, the probability of late 2026 cuts increases. Structural risks remain. Persistent services inflation, housing cost stickiness, geopolitical supply shocks. Each can delay easing, but there is also a stabilizing force. The U.S. economy remains diversified. Consumer balance sheets are healthier than pre-2008 levels. Corporate earnings overall remain positive. This is not a crisis scenario. It's a recalibration phase. Now let's bring this back to you. Think of your personal finances. If your income is stable but expenses are rising slightly, you don't immediately take on more debt. You wait, you assess, you build a cushion. That's what the Fed is doing. Waiting, assessing, holding steady. For investors, the message is clear. Do not base decisions on hope for quick cuts. Base them on data. Higher for longer may be the base case. Position portfolios accordingly. Balance growth exposure with quality and cash flow strength. Consider fixed income opportunities, now offering real yields, and stay flexible
because policy can shift quickly if the data changes. Let's recap. Core CPI at 3.60%, PCE trend at 2.71%, rates steady after January's pause, no rush to cut, banks benefiting from wider margins, growth stocks facing valuation pressure, smart money holding selective cash. Upcoming inflation data remains the key catalyst. The Fed has not slammed the brakes, but it has taken its foot off the accelerator of easing, and in markets, that subtle difference matters. If you found this deep dive hopeful, subscribe for more data-driven breakdowns, because in an environment where every basis point counts, clarity is your biggest asset.